Most people believe the only way to make money is to work more hours. Clock in, clock out, repeat. But there's another side of money most people never learn, a side where your money works without you being present. That's where dividends come in. Dividends are simply payments companies make to their owners. And if you own shares of that company, you're one of those owners. Think of it like this. If you help fund a business and that business makes steady profits, it makes sense for them to share some of that success with you. Dividends are that thank you. Now, not every company pays dividends. Fast-growing companies usually keep their profits to expand, hire, and innovate. But companies that are already established, the ones selling products people buy every day, often have extra cash. Instead of letting it sit, they distribute part of it to shareholders. That's why dividend-paying companies tend to be stable and predictable, not flashy. Here's a simple example. Imagine you invest $5,000 into a company that pays a 4% dividend. That means you receive about $200 a year just for owning the shares. You didn't sell anything. You didn't work extra hours. You simply held the investment. Now here's where most beginners miss the real power. Instead of spending that $200, you can reinvest it. That $200 buys more shares. More shares pay more dividends. More dividends buy even more shares. Over time, this creates a compounding effect, like a snowball slowly rolling downhill and getting bigger every year. This is why dividend investing isn't about getting rich fast. It's about building income steadily and predictably. One mistake many beginners make is chasing extremely high dividend yields. A company offering 10% or 12% sounds exciting, but very often that high yield is a warning sign. It usually means the stock price has fallen because the business is struggling. Strong dividend investors focus on consistency and growth, not just big numbers. A healthy dividend investment is one that pays reliably, can afford its payments, grows slowly over time. That's why many investors prefer dividend ETFs. These funds own hundreds of dividend-paying companies at once, spreading risk and providing steady income without needing to pick individual stocks. Over long periods, dividends can do more than just supplement income. With patience and consistency, they can eventually help cover real expenses, groceries, rent, or even retirement needs. The key is simple. Start early, stay consistent. Reinvest when possible. Think long-term dividends aren't magic. They're discipline, patience, and time working together. And when you understand that, money stops feeling like something you're always chasing and starts feeling like something that's finally working with you. Here at Smart Money Friend, we're learning money the friendly way, one habit at a time. If this video helped you, subscribe for more simple money lessons. At its core, a dividend is a share of a company's profits. When you buy stock in a company, you're not just buying a piece of paper or a number on a screen. You're becoming a partial owner of that business. If that business makes money consistently, it has choices. Reinvest profits back into the business or share part of those profits with its owners. When a company chooses option 2, that payment is called a dividend. So dividends are not free money. They are earned money paid to people who own part of the business. Let's walk through a simple example. Imagine you invest $5,000 into a company or fund that pays a 4% annual dividend. That means you receive about $200 per year, usually paid quarterly or monthly. You don't sell your investment. You still own the shares you're being paid for holding, not trading. Now here's the key idea many people miss. Dividends pay you without reducing your ownership. Your investment stays invested. Your shares remain yours, and the company continues working for you. This is where dividends go from nice to powerful. Instead of spending the dividend money, you can reinvest it. This means the dividends buy more shares automatically. Those new shares pay dividends too. Increase future income compound over time. This creates a cycle. Money, dividends, more shares, more dividends over many years. This compounding effect can be massive, even if you start small. Dividend investing is not about speed, it's about time and consistency. Dividend yield is simply how much a company pays in dividends compared to its price. Higher does not always mean better. Very high yields can be dangerous because they may signal falling stock prices, financial trouble, unsustainable payouts. Healthy dividend investors usually look for Moderate yield, stable companies. Long-term consistency. Slow and steady beats risky and unstable. A safe dividend usually comes from a company that has steady profits, has enough cash flow, doesn't pay out almost all its money. One measure people use is the payout ratio. This shows how much of their profit they pay as dividends. Example, if a company earns $1 million and pays $900,000 as dividends, that leaves them with very little breathing room. If business slows down, dividends may get cut. A healthier payout ratio is often around 30% to 60% general guideline. It means the company can pay dividends and still stay strong. Here's a smart mindset shift. A dividend that grows is better than a dividend that's just high. Example, stock A pays 3% but increases every year. Stock B pays 6% but never grows. In 10 to 20 years, the 3% growing dividend can become powerful because your income rises over time. It helps beat inflation and keeps increasing your future cash flow. If you don't want to pick individual stocks, dividend ETFs can help. A dividend ETF is a fund that owns many dividend-paying companies. So instead of buying one company, you buy a basket. Benefits: diversification, less stress, steadier income. Easier for beginners. This is a simple way to start learning. Can dividends replace your job? Yes, but it takes time. Let's say you want $1,000 per month in dividend income. That's $12,000 per year. If your portfolio yields 4% per year, you'd need about $12,000 divided by 0.04 equals $300,000 invested for $4,000 per month. $48,000 divided by 0.04 equals $1.2 million invested. That might sound big, but remember, you don't build it overnight. You build it with consistency. Time reinvesting, compounding dividends are not a shortcut. They're a long game. So dividends are simply a way to get paid for owning part of a profitable company. The winning strategy is don't chase high yields. Focus on strong businesses, reinvest when possible, stay consistent for years. Remember, building wealth isn't about getting rich fast. It's about making smart choices consistently. Stay patient, stay focused, and let your money work for you. If this video helped you, please like, subscribe, and support the channel Smart Money Friend. I'll see you in the next video.